Welcome to the presentation of the results of the first half year 2024 of Palfinger AG. My name is Felix Strohbichler, I'm the CFO of Palfinger. First of all, let me remind you, Palfinger is the number one in the market for crane and lifting solutions with a revenue of around 2.5 billion in 2023. We are present in all regions worldwide with 30 production sites, and what is even more important for our customers is that we are present with 5,000 service centers, a real USP for Palfinger. We employ around 12,650 people, and at the bottom of the slide you can see our revenue distribution, around 60% coming from the EMEA region, and already 27% are generated in North America, by far the biggest growth market for Palfinger. And then you see that in the other regions we are doing around 4 to 5%. Palfinger has a very broad product offering, and we are serving a lot of customer segments, which makes us resilient in case of a downturn in one or the other segment. Around 40% of our solutions are going into the construction industry, around 10% is forestry. Then we are also serving customers in waste management, recycling, transportation, rental business. We are also serving the marine industry in oil and gas, agriculture, fishing. We are delivering offshore wind cranes. And last but not least, we are also delivering maintenance solutions for rail cars. Sustainability is a key driver for Palfinger on an operational basis, but of course also as a strategic driver. We are focusing on reducing the emissions. I just would like to highlight that already more than 80% of the electricity we use is coming from renewable energy. We focus clearly on health and safety, not only of our own workforce, but also of our customers and all the people who are close to our solutions. And last but not least, governance, transparency are very important values for Palfinger. Coming now to the KPIs of the first half year, revenue has slightly declined by 3% to 1.175 billion euros. What is by far more important is that we could further improve the EBIT line from 111 million in the last year, which was already a record year, to 112.2 million in 2024 in the first 6 months. This is coming from significant improvements in earnings in North America, marine and tail lifts, which could compensate and even overcompensate the reduction in the EMEA market, which is still difficult, especially in construction industry. If you look at the EBIT margin, another improvement from 9.2% last year to 9.5%. And what is of course key for our investors is that the consolidated net result is improving by 8% over proportionally to 68.3 million. Coming to the balance sheet, Palfinger is a very solid company with a very stable balance sheet. All balance sheet KPIs on this slide have improved. The equity ratio at 34.3% is extremely healthy, and net debt EBITDA at 2.5 is a very good level. ROCE at 11% is not far away from our target level, but clearly not the end of the story. What I also would like to mention here is that our net financial debt has increased to 763 million. This is due to the fact that we still have high stock levels, which however will decrease in the coming months. Last but not least, the free cash flow development in the first half year, we still show a negative free cash flow of minus 22 million, mainly based on the fact that the working capital still is a negative impact on our cash flow, and also based on the fact that we had a record level in investments in the first half year. However, the investments will go down in the second half year. Working capital is expected to improve substantially, so that for the whole year we do expect a clearly positive free cash flow in the end. Coming finally to the outlook for the whole year. So we expect that the positive development in North America, APAC, LATAM and in the marine sector will continue. However, in our core market EMEA, we still see that there is no sign of a recovery, which will also lead to further low order intakes. And in order to react to this, we will further adjust our production capacity in the second half of the year. This means that we will see a slight decline in revenue for the current year compared to the previous year, and the EBIT will be up to 20% lower than in the record year 2023. However, this still means it's the second best year in the Palfinger. Our focus will be clearly on achieving a clearly positive free cash flow, by reducing working capital and investment volume. A key message I want you to take away is that Palfinger will now use this difficult time to strengthen our market position and to prepare ourselves for the next upturn. Thank you.
Disclaimer. As described in the legal section on our website, c11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. C11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.